Whoa, 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 whoa. I'm Rodd Duff, your host.
And I'm producer Barbie.
And together,
we bring you our podcast,
Insights and Straight Talk. And with that, producer Barbie and I are out. Hey, everybody, how you doing? Look, today I want to plant this wish within your own space. I pray that everybody had at least a single wonderful moment shared with families or friends over these Christmas holidays. I also want to thank our newest sponsors, the Mangum City Library and Leaf Lab, and others, of course, but thank you both for supporting this mission of ours. It's meant the world to us and everyone in the great middle class of this civilized world. All right, everybody grab your coffee or your tea, maybe grab some kombucha, because today we're going to say something out loud that a lot of working people think, but almost nobody explains clearly. The stock market is not supposed to feel like a casino, right? But a whole lot of folks, that's exactly what it feels like. And here's the thing. If investing feels confusing, risky, or overwhelming, it's not because you're irresponsible. It's not because you're bad with money, right? It's definitely not because you didn't work hard enough, folks. It's because most people were never taught how to invest responsibly. They were told to save. They were told to contribute. They were told to just leave it alone and hope it all works out. But let's be real. Hope's not a strategy. Now, I want to ground this conversation in something personal for just a moment. Producer Barbie, who many of you know as the calm, the steady force behind this show, she started using this type of responsible risk-first strategy to help secure her own personal future, not chasing hype, not gambling, not staring at screens all day, but learning a structured approach that has allowed her to move forward while still sleeping well at night. And you know what? That matters, because confidence, it doesn't come from taking bigger risks. It comes from understanding what you're doing and why. This show exists for the great middle class and people who show up every day, raise families, they build businesses, run departments, manage teams, and yet still quietly ask, am I actually going to be okay long term? Why? Inflation doesn't wait. Life doesn't ever slow down, really, and retirement shouldn't feel like a roll of the dice. Producer Barbie and I, as you guys know, talk to a lot of experts on this show. Finance, business, AI, real estate, leadership, and other topics. But the thing is, the one thing we've learned is this. People aren't looking for hype anymore. They're looking for clarity. They're looking for confidence, right? They're looking for a way to grow without risking everything they've worked for. That's why today's conversation matters, because our guest does not treat investing like a thrill ride. He doesn't sell shortcuts, and he doesn't promise overnight freedom. He doesn't believe busy professionals should be staring at screens all day, trying to outtrade the market. Our guest today is Fadi Habib, engineer, professor, longtime real estate investor, and founder of the Legacy Wealth Builder Academy. Fadi spent decades in corporate leadership. So what does that say? He understands responsibility. He understands risk. And like many people, when he first heard about options, he thought what many of you might be thinking right now. Isn't that gambling? That question alone tells me someone is thinking responsibly. Because what Fadi discovered and what he now teaches is that options, when used correctly, are not about betting. They're about structure. They're about, they're about protecting capital first, creating predictable income, using simple, repeatable strategies, and managing risk before chasing reward. And you know what? That phrase, risk before reward, is something we don't hear enough anymore. We live in a culture that celebrates upside and ignores downside. But grown-up money decisions work the opposite way. This conversation respects people's time. This isn't about quitting your job. This is not about becoming a trader. It's not about chasing somebody's version of success. It's about giving professionals a framework they can actually understand, right? Something that fits real life, real schedules, real responsibilities. So, if you've ever felt burned by past investments, right? Overwhelmed by jargon. Oh my God. Yeah, here. Hesitant because you didn't want to make a costly mistake, none of which any of us can much afford. Or stuck doing everything right, but still unsure where it leads. You're in the right place. Any of those things, you're in the right place. This is not a hype show. This is not financial theater. This is straight talk. Let's get into this thing. Fadi, how you doing, brother?
I'm great. Happy to be here, Rob.
I'm very happy for you to be here because I need to get some stuff straight. Wow, we already have 121 people on. Hey, please subscribe. Welcome aboard. This is going to be a great conversation, everybody. Fadi, we've talked a couple of things back in the by the way, I'm saying that name correctly, right? We never discussed it back
No,
there.
that's correct, Fadi. Correct.
All right, perfect. So as we were talking, we were going through a few different things, and one of the things I'm always interested in with people is you're on a journey now that journey has brought us together in this moment. Obviously, here we are, right? What's how did this go? I mean, we've just talked about, we know about your past, but what brought you onto this journey? Why this decision?
So very quickly, when I was in the university, I did everything that my parents and everybody in the society wanted me to do. Basically, I got good grades, graduated, got a good job. My problem was that, and my job had high salary, always had high salary postings, but I'm always don't have enough. I don't have enough to buy a good car. I don't have enough to go to the trips that I want. So I was always searching for wealth. And I got it very quickly that being an engineer is not the way, or going to the 9 to 5 is a good way to pay the bills for sure, but it's not the road to wealth or freedom. I read this book 20, 30 years ago called The Cash Flow Quadrant with Robert Kiyosaki. And I learned that there are 4 ways to make money. Employee is where everybody is pushed towards. Maybe a little bit of a self-employed, a carpenter in their shop, a doctor in their clinic. But really, what we need to be is on the right side of the quadrant, mainly business owner and investor. So I said, I need to be an investor. The problem here is my parents, my family are not investors. They have no idea about this. I did not learn at school. No school teaches it really. So the burden was on me to teach myself. Took a lot of courses. I started with investing in real estate, did a lot of mistakes in the beginning, especially that a lot of people that are teaching out there are not really 100% ethical or straightforward. Made a lot of money. And then 15 years ago, as you said, Rod, I thought that any responsible investor should not touch the stock market because it seemed like a casino. The reason I knew that is that everybody around me is losing money. So it's a casino. I'm a risk averse person. I don't have any interest in losing money. So I'm out. And then one day, one of my friends told me, listen, there's this course about options, you should go. And I went there with a motive of trying to prove myself right. I had a confirmation bias. And that the guy who will be speaking doesn't know what he's doing. And I was pleasantly surprised. I understood, like, I guess we'll talk about that later, that there's different sorts of investment. And same as driving, there's driving a car, a racing car, a motorcycle, or some people drive a motorcycle on a rope in the circus. The risk level of all of these are different, right? We can't say that driving a car is risky. Everything has a risk, of course, but it's not. We hear about the people who lose money are the people who don't have strategy. They have never been taught properly, which most of us are basically. And the stock market gives this tendency for people to use it as a casino because it's a great way to gamble if you want to gamble. So understood it, took a lot of courses, learned it. The people who took the course told me, why don't you coach for us? Which I did. And then last year I did my own business designing the perfect program, mentorship program for people who want to learn this, putting all the things that I learned and the things that I needed to start. So that's kind of in a nutshell where we're here now.
Wow, I love that story because it shows kind of part of the theme of this show, which is, you're not going to get a lot of help from, if you have somewhat limited assets or the less assets you have access to, the less information you're going to be able to drive forward in empowering and bettering your own life or your family's life. So you took that thing that we all need to do, which is go internal. I got a roadblock here. This doesn't seem right. So I'm going to teach myself. I'm going to go through the process and teach myself. What did that look like? How did you develop what you were now is your life's work?
So how did it look like in the beginning? I was lost, basically. I didn't know.
Sure.
One of the biggest problems is that you don't know what you don't know. So I don't know where to start. But I had this hunger. I had this eagerness to find. I knew that there's something wrong. Like, I need to learn something to make wealth, but I didn't know. So in the beginning, it was trial and error. I read books. I took courses that some of it wasn't right, wasn't sometimes ethical, I would say. And there was a lot of people out there who are scammers, basically.
Wait. Hold on. Just, I don't want to skip over this. I totally get what you're saying, but you're saying you've read some books that actually within those books, you discovered some not so ethical teachings that they were giving you. Go ahead.
The ethical stuff is the courses. So like when you take a real estate course and they tell you treat the tenants as shit and at the last minute change what you agreed to before the closing, that's all unethical stuff. Right? Like later, like here's the thing: once you are committed to it, it's okay to make mistakes. It's okay to go to courses that are bad because you will learn once you find out a good course that this is a good course and this is what I want to follow. So mistakes will happen and don't shy away from that as long as you don't die from the mistake, right? When you learn how to swim, you gotta learn how to swim in a safe place, like in a pool where it's shallow. Don't jump into the deep sea thinking that you're learning how to swim. Or if you're learning how to drive, don't go to the highway first time you have a car. So you gotta protect yourself like as a nursery in the beginning. But you're going to make mistakes, and that's okay. That's normal. That is the price of your parent not teaching you the thing. And it's okay. I took responsibility. Didn't really cry about it. Yes, okay. None of my family know this, but I'm interested. I'll do what it takes. And it took years. Right? Because I did it all by myself. But in the beginning, you feel lost. You're okay to make mistakes. You're trying to shorten the time as much as possible. You want to make sure that you don't kill yourself in the process of learning how to swim or learning how to drive. Again, being responsible meaning taking on whatever you need to take on to be successful, basically.
That is, and so you spent years developing this. through trial and error and through just your own frustration of not trusting the courses or some of the stuff that's out there that you could rely on to become successful at this venture, at this action,
Right.
this activity. What is okay? Let's get into what you do right now. So you're teaching people through this academy. What is that academy? Let's get through the academy thing. Let's put a
Okay.
frame on that, time wise, all that stuff, all those. And by the way, before we end, you said we have an hour and a half. So before we end, towards the end, you see the private chat there on the right side of your.
Yes.
Okay. At some point, put your contact information in there that
Okay.
you want people to contact you on. Because I'm telling you, you know this. An hour after the show, 10 minutes after the show, 2 years after the show, somebody's going to go. They're going to come across the show and they're going to go, "Oh, I wish I was talked to Fadi about this because this is really important." Or for me, it's vital. And so now we're taking the risk that they're going to leave a comment on the actual show, which I love. Don't not do that, folks. But this way they can contact you directly and be in contact with you sooner. Because I don't know when I answer those
Beautiful.
shows.
Good. So I do have a program. It's a 12-week mentorship program.
Okay,
And
there you
the
go.
way I developed this is that I asked myself, what do I need? Because I took a lot of courses. Each course had a good thing and not a very good thing. Some courses are complete, they promise a lot. Some courses, they tell you it's coaching, but when you go in, the person who is pitching the course to you is different than the person teaching inside. They tell you it's coaching, but you go to a coaching call, there are like 300 people on it. You're lucky if you have a question. Most of the things out there are courses, and I figured it out very quickly that the chances of people implementing something in a course is the statistics say, Rodd, that 3% of the people who take a course finish it and they never implement it because it's very hard. And it makes sense.
3%.
Imagine
3%.
3%.
Wow. You hear?
So-
hey, hold on. You hear that, folks? We have 230 people on right now. So listen to what we're talking about here, because that's a really bad number. 3%, all that money spent, and that's the result. Go ahead with what you were saying. Sorry, I just wanted to I wanted to hover there.
Imagine if you're learning swimming from YouTube, or you actually bought a course. Sometimes it's thousands of dollars. Some people teach like courses with $10,000. It's a bunch of videos. Can you really learn how to swim learning videos, seeing videos? You can't. You will take a lot of information. You cannot ride horses. You got to get somebody with you in the stable, in the swimming pool, because it needs that kind of feedback. The video courses will never give you feedback. So I divide it into different elements. Number one is knowledge. You need knowledge because it's something new to you, and you need a system, but also you need feedback. You also need this feedback in terms of somebody looking at what you're doing and saying, this is good, this is not as great. This is, you know what? I see that there's a mistake here. Can you find it? And with this dialogue, this learning, this feedback, the compound effect week after week in the coaching gets a lot of things, gets a lot of progress. One of the main things as well in this program that I thought of is you have to, you cannot use your own money learning. Meaning, if you're investing, you cannot use your own money starting doing things, making mistakes, losing money. So part of the main rules in my program, and if I caught somebody not doing it, he or she gets kicked out, is that you cannot use your money. You have to use something called a paper trading account. A paper trading account is a free account. You open it for free. You don't have to put any money, and you learn through it. They give you $1 million monopoly money, meaning fake money. Everything is real. Everything is real except the money, which means you will not make money, but you will also not lose money. Okay. And I tell people within this 12 weeks, you have to prove to yourself that you can make money in the paper trading account before you commit any money. And I tell them honestly, If you do not make money in a paper trading account, you have no business putting money, because you're going to just lose your money. And it means few things. It means either the person who's teaching you doesn't know what they're saying. That's a possibility. Or you're making mistakes, or you didn't understand the strategy. Regardless what the issue is, gotta be fixed in the paper trading account. Okay? You cannot just jump into using your own money, because I have no interest. Like, if we take one step back, the number one objective in the game of making money in the stock market is not making money. It's preserving your capital. So you preserve your capital first. Then number two, you get the best ROI you can. Okay? People who go into the stock market, and that's why everybody's losing money. People who go to the stock market with this priority switched, meaning I want to get the best ROI possible. And they forget that they got to protect their money, because what is the use of you making great money first month, second month, third month, and losing it all fourth? That's not smart, right. Not right. And that's why all these people that are around you are losing money, is that they there's a lot of myth that we can talk about if people want, about the myth of the stock market. You need to understand the behavior of the stock market, because it behaves in a certain way. So you need to understand if this is normal or not normal. Number two, you need to understand there's some rules that you have to understand.
Wait. Don't skip over that. When you say, is this normal or not normal, are you talking about a trend that's currently happening where you're trying to make decisions on? Is that what you meant by that?
I meant that a few things, for example, that the market corrects every now and then. Is this normal? It is normal.
That is true.
You need to understand that the market breathes. It's like me inhaling and exhaling. The market will exhale at times, and it's completely normal. We have the statistics. We know every year it's going to go down by like twice 5%, at least once 10%, every year and a half. Like, we have the statistics. Every 5 units of time, the market goes up or sideways 4 units of time and goes down 1. So when it goes down 1, there is nothing abnormal, you guys. It's normal. You need to understand that it's normal so that you don't panic, because panicking means losing money. Because people, like, I'm going to talk about a few things here, but it's normal. Okay, 4 times up, 1 time down. Okay, it can be 4 years up, 1 year down, 4 months up, 4 minutes up. But it is normal to correct, and the market is volatile. It's not like the real estate market. The real estate market, the cycles are much longer. It takes a lot of time to go.
Yeah.
The stock market goes up 4 times, goes up slowly, and goes down once very quick. But you also need to understand that the US stock market is extremely strong. It's like 60% strength of all the stock markets in the world. And because of the innovation of the US companies, just look at the last 30 years, amount of innovation we had. The stock market in the US, it never went down and did not recover. Never in the last 200 years. Okay. Overall, you need to understand that overall, it goes up by 11% a year. You should know that with the 4 units up, 1 unit down, overall it's up. So if you just buy the SPY is an ETF, which is an exchange traded fund. Basically, think of it as a basket of 500 companies. Okay? It's a basket of big 500 companies. If you just buy the SPY and do nothing, just go in a coma for a few years, for 5 years, 10 years. If you do nothing, you should expect to go up by 10, 11%. That's if you do nothing. Of course, when you take a little bit of a more an active role like me, you should expect more. Okay? So that's one thing you need to understand, that when the market corrects, there's nothing wrong. As long as you did not make mistakes or put yourself in positions whereby you will die when the market goes down, right? We don't want that. We want responsible investing whereby we are okay if the market goes down every now and then. We know it is normal. I can sleep well at night. Very important for me that I don't sleep at night. I tell people, if you can't sleep at night, you're gambling. You're not investing. Investing means you know what you're doing. You have a strategy. It's proven. Okay. The second thing is people sometimes use the stocks are lottery tickets. They think it's lottery ticket. It's not. You're buying a business. Even real estate investors, where I'm coming from, they know that if you want to buy a rental property, you need to ask a few questions like, what is the rent? Is it a good location? What are the expenses? Is it cash flowing? What is the cap rate? Or any real estate investor will ask these questions before they buy a rental property. Is it cash flowing? Is it like, For some reason, the same people who are really prudent, when they come to the stock market, all the extent of things they do is that one of their friends told them, listen, look at this stock, it's really going up, buy it. That's gambling. One of my rules, if you buy any company without looking at the balance sheet, income statement, and something called free cash flow or cash flow statement, you're gambling because you're buying a business, right? If you have two Starbucks in front of you, one of them is losing money, one of them is making money. If you want to invest, which one are you going to put your money on, right? The one that is making money, because it's a business. The number one objective of a business is only one thing, is to make money. It's not to make good products or sexy products, right? That it's not a charity, it's a business. So a company like BlackBerry, and I love them because I worked for BlackBerry for 6 years. I will never invest in BlackBerry. Why? Because it has been losing money for 5 years. So I will buy the product. I'm a big fan of BlackBerry. Right now, I don't think they're producing any. But
wait, I was going to say, wait. You're still a fan of BlackBerry because they're kind of gone, right?
So it's gone. But I was a fan of BlackBerry. I still root for them. I'm not going to invest with them, right? So if you have a company that you like the products, that is not enough for you to buy it as an investment. It has to make money.
I get you.
Okay, so I will buy the product, but I'm not going to invest because I don't want to lose my money, right? So one of the important things that that anybody needs to understand as well is that you need to know how to evaluate a business. And for me, there's a criteria for me to evaluate a business. Number one, is it making money? By the way, there's about 6,000 companies in the US market and in the stock exchange, and then there are free screeners. And the first thing I screen is that they have positive earnings. They're just making money. So if I go to any of these free screeners and I put EPS, earnings per share, more than zero, meaning just making money, I'll tell you, 45% of the companies that are there will be out, meaning so many companies are losing money.
Out of 6,000.
Yeah. So many, like 2,000, 2,500 are out. Just one criteria. And I'm not saying that they have to have a certain limit of profit. I'm just saying they're just making money. It's amazing. So if you're randomly choosing stocks or just one of your friends, what are the chances you're going to get a good company? By the way, one of the other statistics I want to share is that in the last 100 years, the percent of companies that created all the wealth in the stock market is only 3%. Let me just say that again. Only 3% of the companies made all the wealth in the stock market. So if you're randomly choosing stocks, the chances of you getting to a good stock is 1 out of 25. And because it's a big casino out there, everybody does not do any research. They don't understand how to do research. Not that they are at fault. It's just that they didn't know. All the people around them this is the way they choose stocks. The chance of you landing on a good stock is really small. So you need to know how to figure out what is a good stock, and I can talk about that. The other thing I want to talk about is psychology. The normal behavior of a person who is not trained is that they will see a stock that is going up. They will think it's going to go up forever. So they buy at the top, okay? And then as soon as it goes down, because all stocks go down because we know that it corrects every now and then, when it goes down, they will panic and they will sell at the bottom. That's another reason why everybody's losing, because it's a behavior that repeats all the time. You buy at the top, you wait, it goes down, and you need to change that mentality. So let's talk about that. If you go to the market every day to buy a kilo of tomato or a pound of tomato, and you know that the good kilo of good tomatoes cost $5 a pound, okay? You know that. Every day you do that. And then one day you went and the good tomatoes are $2. Are you going to panic? What are you going to do? You should buy. It's $2. It's good tomatoes. I want to tell you how stupid the normal position of a person is. When they see that it's $2, they're going to go home, get the tomato that he bought yesterday with $5 and sell it at $2. That's what people happen. That's what people do, right?
I get that. Yeah.
So the normal psychology of people works against people to make them lose money. And a lot of people in the stock market use that to make you part with your own money. So if you understand that the market corrects, there's nothing wrong about that. If you understand that you're buying a business, so you need to choose what is a good business. We can talk about how to choose that. And if you understand that when the market goes down, it's not a time to sell. If you have a good business, if you have a good product, it's a time to buy. Like Meta, for example, Facebook. At some point of time, it was at $400. And in 2022, by the end of 22, went down from 400 to 80. Okay, it lost 80% of its price, not value, because it is a good company. It is pumping a lot of profits. It's pumping a lot of revenue. It has a lot of something called free cash flow, which we can explain. It's a good company. And if you know that the intrinsic value of the real value of the company, again, not a lot of people know this because it's not very easy to find. There's actually a real value for, like, there's some math that can be done to figure out forget about the price of the stock. The price of the stock and the value of the stock has nothing to do with each other in the short term. In the short term, the stock market is like a teenage drunken party. Think of it this way. Somebody who is drunk wakes up in the morning, assign prices to the different stocks. It has nothing to do with the value of the stock. So you need to find a way to find the value of the stock. It's called intrinsic value. There's some other ways. But you should not be looking at the prices of the stocks as any indication of its value at all, because some bad stocks will keep on going up. Some good stocks will keep on going down. Peter Lynch said that in the short term in the stock market is 2 years. There is often no correlation between the price and the value. However, which is very important, the next part of the statement, in the long term, there is 100% correlation between the value of the stock and the price of the stock. Meaning, if you have a good stock like Meta, it is profitable, lots of money, lots of billions and billions of profit, lots of cash flow. In the long term means 5 years plus, regardless of what happens in the short term, it will go up and match the value. So if you limit your dealings in the stock market with good companies, good solid companies that you believe in and you know that have been a history of making money, they have good ROIC, return on investing, good management, good return on investment, you will know that on the long term, even if it goes down now, it will go up later. Okay, and that's how you approach the whole thing. It's systematic. It's based on logic. Nothing really of what I said is illogical, right? It's a business. You gotta buy a business that is profitable. It's simple, right? Like, avoid companies that are not profitable. Better, you want companies that have certain, like Apple, for example. The revenue of Apple is the earnings of Apple, $100 billion. That's more than the GDP of a few countries combined. Apple, for example, has a free cash flow of, I don't know, more than 80, 90 billion. That's a lot, maybe 60, I forgot. That's a lot of free cash flow. And when you have cash flow, companies can do a lot of good things, like investing in R&D, because they need to research and develop their next new thing that will get them more billions. They can buy other companies. They can weather storms like COVID.
Hold on. So free cash flow, which I'm kind of understanding what you're talking about, but let's spend a moment in there. And there's a few questions I want to get into as well here.
Yeah. Okay.
They're matching along with what you're talking. But another reason, like R&D, you've got, by the way, there's 517 people on right now. So you're going to, when you have that much free cash flow, now you're more susceptible as a company to taxes and burdens and so forth. So reinvesting, you're actually, instead of paying the government, you're able to use that money. One, you need to do research and development to make your product better, but they're also incentivized to do that, because if they just hold on to it, the government's going to start picking away at it, right? So that's also part of that.
I'm talking from a more simpler way. Forget about saving taxes. I'm talking about two companies. One of them, like BlackBerry, does not have a lot of cash, like $2 million. It's just free cash flow. Look at it as two families. Let's say two families have the same amount of wealth. Let's say both families have $1 million of net worth. The first family, family A, has a factory that is worth $2 million. Okay, 1 million. Let's keep it the same. The other family has $1 million in cash. So both are the same wealth, which is net worth. But one of them has zero cash. The other company has $1 million in cash. Who can afford to go to a vacation? They have the same wealth. Okay, but family too will be able to go buy a nice meal and go to a vacation because it has cash flow. So wealth, or whatever is there in the balance sheet, is one thing which we want it to be strong. But also, I want to look at the cash flow, and I want to look at something called free cash flow. The company that has cash flow, they own their own destiny. They can pay the rent. They can pay their employees. They can withstand 6 months with issues with like sales, like COVID time thing. They can weather the storm. They can also invest in other companies. They can invest in R&D. They can buy back shares. They can give dividends. Bottom line is they can own their own freedom. Not like the other company, that one that does not have cash flow. They have to maybe get into more debt than usual. Think of the family that does not have, that have the factory. They're theoretically rich. They have $1 million factory, but now they have a medical bill that is $10,000. They're in trouble because there's no cash. You know what I'm saying? So understand that it has to be profitable. They have enough cash. They have good management. Some criteria we go through to figure out. By the way, when we apply this criteria, only you need 20 or 30 companies. That's all what we need to have a good life. And same as Warren Buffett said, he has this thing about if any person has a punch card that has 20, like he just needs to make, he or she needs to make 20 decisions, they will be very, very rich. So structured approach, logical approach, forgetting about another thing that is very important that we need. By the way, am I expected to read the questions and answer them or no?
No. I'm trying to read your. There's, I like I said. By the way, this is 441 episodes today. This show is in the last year and a half. That's more for the audience than you. We talked about that. So with different guests, I try and gauge where they are, because I was just getting ready to say.
I'm serving the right way. So you tell me, you stop me, you tell me.
Well, you since you gave me this opportunity, perfect. You got your contact information in here. I just want to point out, you can read this one. I'll read the rest if that makes it easier. That's fine. But read this. What Joel has to say about you.
Where is it?
It's on your screen. Look at right in your screen in the bottom left. Here. Great episode so far. Learning a lot.
Thank you.
Okay?
Thank you, Joel.
So that's where thank you, Joel. I appreciate it, but obviously, Fadi, you appreciate that a bunch. But where I was going to lead off with here with you is Alan Moore. For beginners, what option strategy is the safest place to start? This is a great question to start off on.
Okay.
I think it is.
Okay, good. Anyway. So before we dive into options, or you ask this question, you need to understand stocks first. Okay. So if you, and this is one of the mistakes I did. I went and took a course in options, not really knowing anything about stocks. And is part of, again, what I teach is that I spend the first month of the 3 talking about stocks. So first thing is stocks. So you understand what is a good stock, because it doesn't matter which option strategy you go to. If you don't understand this, it's not going to. So you need to understand what is a good stock. You need to understand how to evaluate stocks, something called intrinsic value. And there are websites that can give you that. Sometimes you have to pay, but it's very valuable to understand that the price of the stock is X, but real value is this. So which means it's undervalued or not. So understand stocks first. Number 2, options. There's like 50 different strategies with options. I only focus on 2. Okay. And the reason is that the way I designed my investing style and my program is I do not want to look at charts all day. When I was having a 9 to 5, I did not have time to look at charts all day. I hated day trading. Right now, I just want to tell everybody, I know this is controversial, but day trading and scalping is a very sure way, everybody, to lose money very quickly. Rarely did I find anyone.
What's scalping? What's scalping?
Scalping is, okay, day trading means you go in and out in a day, day trading. Scalping is an extreme way of doing it, going in and out in a few seconds. So one of the courses I took about scalping is that there was no time to put the order. So I had to program the keyboard. Control C means buy 6, Control F means sell 5. It's so extreme. And one of the main things that you need to understand about the market, everybody, is that the more you're invested in the market, the more you adopt a long-term horizon, the less probability you're going to make money. One of the things I can share at some point is this curve chart that says in the x-axis how many.
Did you want to bring on a? I can help you if you want to bring on a document or something you wanted to share, or is that what you were referring to?
You know what? We can do that. Just give me a second. We can, but I just need to fire up the right presentations because there's so many. Okay, so I'm gonna speak while trying to get this thing up and running. But yes, I think that will be very valuable. It's just that I need to fire up the right thing. So I'm gonna speak, and as well.
Reason I wanted to bring that up is because it looks like there's about at least 5 or 6, just judging from some of the questions. It seems like there's a lot of beginners on here, newer investors. Like this question for beginners, which somebody else is asking, what are the mistakes beginners use?
Ali Moore's question.
No. I know. I'm just saying there's a number of questions. What's the biggest mistake you can see new options investors make? What's the biggest mistake you could see? There's 2 or 3 people asking the same question at the same time. So
I have it. How do I share the slide? Should I put it in the chat, or can I press a button called share?
Do you have the button called share there? You should.
Okay, let me. Is that
should be another box next to your picture and mine down and below, and then the empty one. It's slides, PDFs, extra camera, video file.
Okay, so give me 1 second. I'll just I have 6 screens, so I'm.
I was going to say, it looks like you've got a number of big old screens around there.
Yes. So share screen. I don't know which screen it will share.
It'll once you hit. Is that what you're going to do? Or you can either do an image file or share screen. If you share screen, it'll give you some options of which screen you want to share. And then when you click on,
you see the
there. Okay, there we go. I see something. Hold on.
You see the graph?
I do. I'm going to add. Yep. There we are.
Got it. Okay. Yes, I see it on the screen. So let me just explain what is this. This is a chart on the x-axis, meaning the bottom. It says how many years invested. Okay. And on the y-axis, the vertical line, it says probability of losing money. Okay. So if you invested in the market for 20 years, the probability of you losing money is 0. Let me just say that again. Like if you buy the SPY, which is a bucket that has 500 companies, if you adopt a long-term view, you will get, theoretically, again, nothing is guaranteed because everything has a risk. You will expect about 10 to 11% per year on average, not every year, but on average, but also 0. There is no point on the SPY chart, which I can fire up, that after 20 years, it's lower than where you started. And the more you go down, like 10 years invested, the probability of you losing money is 5%. If you go further to 1 year, it's 25%. So I want you to imagine the people who are doing day trading. Day trading means in and out in a day. I want you to imagine how big that number is. So day trading, probability of you losing money is like 50-50. It's like a toss of a coin. But the more you adopt a long-term view, that's good for you. You will be safer. Okay, so that's saying that. Coming back to Ali Moore's question. So what I do is that I know what is a good stock. I adopt a long-term view. I mainly do cash secured puts and covered calls with the objective of, or with these two strategies, theoretically, you will never, if you do it right, you should never book a loss. Meaning, I cannot go into this, Rod, before I explain options, which, so there's something called assignment, meaning, do you have 5 minutes? I can explain what is options. I have to do.
Yeah.
Okay, got it.
Do you
okay.
need this chart up still or no?
So I stopped it. Okay.
Got it.
Okay. So let me tell you about options. And I do have some slides that can help me with that. Are you okay if I share again?
Sure.
Okay.
Because we've got some options that are coming up now as well. Some questions on options. Okay, got it. So share screen and window and this. Okay, got it. Here. So so I'm the person that is sitting down here, and we're gonna, Ali Moore, I'm gonna use you as my friend. So let's say Ali Moore is the lady sitting in front of me. Me and Ali Moore are very good friends. So every now and then I call Ali Moore and pitch her some business ideas. She's an expert in businesses, and she can give me her idea, her view on the business idea. Okay, so this is the starting point. But I wanted to formalize this relationship. She takes my call anytime. We're close friends. So what I told Ali Moore at some point is, Ali Moore, let's just have this agreement for the next month. In the next month, let's have this agreement that when I call you, you have to pick up. This agreement only valid for the next 30 days. I will call you to pitch you a business idea, and you will take my call and give me your opinion. And if you agree to that, I will give you $10 today. Okay? So in this arrangement, it's an option. I bought the option of calling Ali Moore anytime in the next 30 days. She sold me the option of calling her at any time. So in this agreement, I am the buyer, Ali Moore is the seller. And the $10, we call it the premium. I paid a premium. The buyer of the option has to pay a premium, $10. She collected $10. That's income for her, for something she would do anyway. Remember, you guys, she was taking my call anyway. She wanted to do that. She didn't need to get paid to do it. Okay. So in the next month, A, which is me, the buyer, will have the right to call her. I might not call her. I have the right not to call her. I'm the buyer. But if I call her, she will have to take it. And after the month, that's it. She already collected $10, and that's it. She doesn't need to take my call anymore. And if you can see the jar here, she has been doing that all the time. Every month, she's taking $10. She made a lot of premium, a lot of income. That's the income generation portion of it. But how can we put that into perspective of stocks? So we'll do the same thing again. In this example, Ali Moore is the expert who knows options, responsible option investing. I'm the one who, a normal investor, doesn't know anything. So I have, Fadi, have 100 shares of Meta. Okay, I have 100 shares of Meta, and I bought the shares at 675. Okay, so I have 100 shares of Meta. I bought the shares at 675. But I don't know that Meta is a good stock. I don't know anything. All what I know is that I'm being run by my fears, and I'm so fearful that Meta will go down to 650. Okay, so that's my position as Fadi, who doesn't know anything. Ali Moore is very different. Ali Moore knows that Meta is a really solid stock. Ali Moore knows that the intrinsic value or the real value of Meta is actually 850. Okay, so she knows that the stock right now is undervalued. She wants to buy it at 675. Okay, so this is the starting point. I have stocks at 675 because that's the price right now, but I'm so fearful that it's going to go down to 650. Ali Moore knows that Meta is a good stock. She wants to buy it at 675.
So what happens here is I went to Ali Moore saying, Ali Moore, for the next month, can you promise me that if the stock goes down to 650, you will buy it from me at 650? Because I heard that you like Meta. And Ali Moore said, yes, I like Meta. And you want to buy Meta? And she said, yes, I want to buy Meta. So, okay, if this is the case, would you agree with me that if it goes down in the next month to 650, you will buy it from me at 650? And Ali Moore said, this is a really good deal. I want to buy it at 675. If it goes down to 650, that's even better for me. Remember, there's absolutely no relationship between the price and the value. She knows the value is 850. So it's good for her to buy it at 650, right?
Right.
And for that, in this case, by the way, these are real numbers. I'm not going to pay her $10. I'm going to pay her $1,800. Okay, so that's the premium in this example. So for the next 30 days, for these 100 shares, if and when Meta goes down to 650, Ali Moore will have to buy it from me at 650. She's very happy with that. She collected the premium. And for the next month, Meta might go down to 650. It might not, right? Regardless, in both cases, Ali Moore made the $1,800. So, by the way, statistically, 80% of the time, the option will expire worthless and Ali Moore will not need to buy anything. But just to complete this example, I know this is a foreign thing, but this is called the option chain. Meta is the stock. The price right now is 675. I'm just telling you that this is a real example. And if we choose 650, she will get paid somewhere between the bid and ask, which is $18. So the ROI of this transaction, she will get paid $18 for every share. And if she had to buy it, she will pay 650. So the ROI here is 2.7% in 28 days, which means a 35% annualized return. I know this is too quick. This is too quick, but so let's just summarize what we did here. It's a way to make money as an income, but you need to know a few things. Number one, you need to know what is a good stock, because Ali Moore here is very sophisticated. She will not kind of insure. She kind of gave insurance to me. She will not insure any stock. If you're the insurance company, remember, everyone here paid a lot of premium to insurance companies. All of you have cars, and when you pay an insurance, like think of it this way. If I ask you, did you pay more or you got more from your insurance company? Of course, everybody pays more to the insurance company, right? Because we pay so much premium. What we're doing here, we are the insurance company. Because I know that Meta is good. Like Ali Moore knew that Meta is a good stock and that the real value of Meta is much higher. So she's happy to buy it at whatever price we're talking about. She was able to make this income because she insured the Meta stock from going down to 650. But if it goes down to 650, she's so happy buying it at 650. I know that's a lot, and I just want to make sure that people are not lost. But you can't. The insurance company will not go and insure. If you're an insurance company, don't go and insure all the houses in the hurricane belt. You will get a lot of money, but one day the hurricane will come and you will be decimated, right? So you need to insure good stocks that you know that because of we trust what Peter Lynch said, that there's 100% correlation between the value and the price of the stock in the long term, that I don't mind buying Meta and waiting for 3-4 years for it to go up. Do you know what I'm saying? So like this is the worst case scenario, but I'm not going to lose money in this because I'm going to buy a good stock and wait. If you do this on really bad stocks, you will make a lot of money from premium, but the day will come whereby it will go down and will never go up again. So remember the rules. We are much more. I will gladly forgo higher ROI for the luxury of preserving my capital. So I will always deal with good stocks. Okay? I will always deal with good stocks. I will understand how the market behaves.
Okay, so let me ask you this.
Yeah.
Oh, okay. Well, you were going to ask the same question, Brent. That I'm going to let you know. You got is that kombucha or is that coffee or tea?
It's just tea. Just tea.
I'm stuck on kombucha now. It's a great. But anyway, Branson Hill.
I don't like the taste. But anyway, my wife likes it. But
Yeah. It's a different
Yeah.
taste. No, but it's made from tea, so it's got something. How do you manage risk when the market becomes highly volatile? Because you were just talking about
Right.
we're shifting a little bit. We're going to come back to some of the things you were talking about, but I wanted to get to this because it's kind of critical at this moment. I guarantee a bunch of people are saying, "Okay, you're insuring your stock. You got good stock. You got and all of those things are critical to the investment strategy." But
Yeah.
when it gets volatile, is that a better thing, or does it matter, or what? How do you
Okay.
how do you manage that?
Okay, so before I answer this, we need to understand that there's a difference between the investor mentality and a trader mentality. The trader mentality wants to go in today, go out in few hours or a day or two. So they are so much fixated to the chart and what happens in the news, and when the market goes down, you will see the news everywhere are kind of saying, like everybody's running headless. I'm not like that.
Yeah.
I'm the opposite. I don't care. I make money from volatility, right? So the reason you're getting paid this premium because there's a risk that it goes down. But if we adopt what the position of Ali Moore, well, I forgot the name. I'm sorry.
Ali Moore. Yep.
Ali Moore, correct. If we adopt her position is she doesn't care if the stock goes down to 650. It's good for her. She wanted to buy it at 675. If it went down, she will try to buy more, right? So she doesn't care if there's volatility or it goes down. She's making money from it. She's adopting a long-term view, which means if tomorrow, like if you look at what Warren Buffett says, is that he says, and it's amazing what he says when you think about it. When he buys a stock, he wants it to go down. He says that, right? We're only fixated in a different way. We all have this myth that we need to buy something today, make money from it tomorrow. He doesn't think that way. That's not the way to remember the chart that I gave you. Our psychology is telling us to look at it short term, that I want to buy it today. When you buy a house, do you ask I'm still sharing? Sorry. Anyway, I can stop sharing.
No. Sorry. I was thinking that, never mind. I put up the wrong
no
share.
problem. When you buy a house, do you ask every day how much it is and what is the volatility?
Right.
You don't care. You bought the house, you're going to stick with it. Do you weigh your son every day to see if he or she went? It's just like you're committed to the son, you're committed to the house. You forget about, you don't care about the volatility. In the way we do things, we get premium because of volatility. If I have two stocks, one is more volatile than the other, you get paid more with a volatile stock. Here's the thing. It's all a balance. It's one of the myths of some people actually using the stock market is that they think that they might get ROI without risk. ROI and risk are a couple that can never be separated. So as a sophisticated investor, you guys, anybody who tells you something that it really has really high ROI, please stop and think, where's the risk? Because it's there. Whether you are naive about it or not, whether you see it or not, it does not matter. It's there. So I talk to people who usually ends up losing a lot of money. If you think you can double your money every year, you're going to lose it all. If you think wait,
hold on. Nancy Pelosi figured it all out. She's got like 17,000% returns.
I'm not going to comment.
I don't even
for a normal
I've been wanting to say that for the last 20 minutes.
Yeah,
because
if you're anyway, I don't know.
I know. But I had to say it. I had to.
Yeah, let's talk serious now. So I talk to a lot of people, and some people, I tell them, okay, how much money do you want to, when you want to retire, how much money, because we need to plan. I say, okay, fine, $20,000 per month or $10,000 per month. Okay, good. How much capital do you have? $10,000. So I stop and tell him, so you think you can get 100% ROI per month? That's 1,200% per year? Because remember, his capital is 10,000 and he wants 10,000 per month. In what world, I want you guys to understand that Warren Buffett, his average ROI, this is very important for you to calibrate. His average ROI is 19.6% per year. Okay? So please do not think that you are smarter than Warren Buffett. I know I am not. And
he gets almost 20% on his average return over time.
Yeah.
19%. So he's doing, no wonder he's so fit. I mean, I know who Warren Buffett is.
But I'm telling you, a lot of people are not okay. Like when I tell them my target is 24%, they still tell me this is too low. What in what word this is too low? What are you?
That makes no
Here's
sense.
the thing: there's so many ads out there about day trading, and people made $100,000 in 2 weeks, and crypto, and all this stuff. People think because all the ads and all the media is pushing people to think of it as a casino, right? It's you're going to make a lot of money very quickly, and the reality is the opposite. You're not going to make a lot. You can make a lot of money, but in a structured approach, in a responsible approach, I don't think 24% here is slow. It's not slow at all. For me, it's not slow.
It's awesome. I mean, 20. Imagine just on your money getting 20, basically getting 20% year after year after year, and then after a while, you're gaining off of your gains.
So,
now you're playing with house money.
Yeah, compound interest is very important.
Compound.
And with 24% a year, there's a rule called 72. If you take 72 divided by the percent ROI that you're getting, you will get how many years do you need to double your money. So if your money is at, let's say, 6%, okay, this means that 72 divided by 6, meaning it will take, is that 12? Sorry.
Yeah, that's correct.
12,
that's correct.
12 years. It will need 12 years to double your money. If you're getting 10% return, means it will take 7 years, 7.2 years to double your money. With 24, you double it every 3 years. Again, the beauty of the 24 is not because it's high, is that in my view, and I'm not giving financial advice here, that's just my experience. This 24 is a sweet spot between not very humongous ROI and the main thing, which is protecting your capital. At any point of time, I will accept less ROI so that my capital, again, your job is to protect your capital. Okay, your job is to protect your capital. That's the golden goose, right? At any point of time, you do not want to go to a place whereby you're doing so risky strategies or risky positions, whereby the problem here is this: people make money with the risky strategies in the beginning. The problem here is after 3-4 months or after 3-4 years, risk is not after the profit you're making. Listen to this: risk is after your capital. You will give everything you made plus your capital, and your recovery will be really hard. So that's what Warren Buffett said: don't lose money. First rule, which it's the same as don't lose your capital or protect your money. Don't lose your capital. And rule number two is do the same thing. So the main message that I want to give is this: number one, there is a way to make money with responsible investing, whether real estate or stocks. No gambling, no get-rich-quick scheme. Don't run after these people. Number two, understand the game. You need to understand it. The real estate is very different than stocks. The behavior of the market is different. You need to understand what is normal so that you're not panicky all the time. You need to understand that the normal behavior is that people buy at the top, sell at the bottom. So you need to have a little bit of a strength in psychology and real understanding, because you will need to make money in the opposite. You need to sell when everybody's buying and buy when everybody's selling. And just following your friends or following the herd mentality, just a sure way of losing money. So you can learn it. That's the message. You can learn it, but you gotta be.
You know what's crazy right now? You know what's crazy? I just looked up at the clock, and I swear to God, I thought we've been talking 15, 20, maybe 30 minutes. We're at an hour and 5 minutes.
I know. I can speak about this for 6 hours if you let me.
But I mean, financial matters aren't always necessarily free-flowing conversation. It's gone by pretty quick.
Busy professionals really manage this in 10, 30 minutes a day. Yes, you can manage it in 10 to 15 minutes a day. Yes. Again, I chose strategies to allow. It's not that any strategy or anything you do, you can manage something with zero time for 20 years. Like if you just buy the SPY, you'd need to do nothing for 20 years.
What does the SPY mean?
SPY, okay.
You've said that a couple times now. It's basically
is the ticker symbol.
Group of stock.
Yeah. Is
okay.
Is the ticker symbol for is the ticker symbol for, and I can show you the chart of it, for this bucket of basket of, think of it as a basket of 500 companies in it, 5 big companies in it. Okay.
Right.
So that is called the SPY. Okay. And if you buy the SPY, which is kind of you're buying the market, can I share something?
Yeah. Hey, by the way, just so you know, we've still got probably 10, 12 questions or so. Well, probably more than that, actually. But
Okay.
but you've got an hour and a half. So are you still okay? I mean, you said
I'm okay
1:30,
I'm
which
okay
is
for 20 more minutes.
okay. So
Okay.
so yes, please share this. But let's also kind of run through some of these because I don't like not answering people's questions
Okay.
because
Sorry.
it's their time is what.
Okay.
No,
Got
no,
it.
no, no worries. Just
So I
okay.
shared
So
something, but I don't see. Yeah, I shared. Okay, so this is called the SPY, and this is the chart of the SPY. So think of it this way: every dot here represents the combined performance of 500 companies. So as you can see, and if I do it, let's say for every week. So this is the market since 1994. As you can see, it's going up, and that's compound 10 to 11% per year. Okay, so if you buy the SPY at any point and you wait for 10, 20 years, you should expect 10 to 11% per year on average. And again, the market goes up and down, as I told you. But the overall, it's about 10 to 11%. So Clayton, it's all about the strategy. So this is one strategy that people do not want to do anything, just want to buy the SPY and do nothing. With what I'm doing, I'm choosing 2 low risk strategies that can be managed totally with 10 to 15 minutes a day. So the answer is yes. Just wanted to do that. So tell me where are the questions, and I will answer them. So you tell me where's the questions. What's the biggest mistake you see? The biggest mistake is thinking that it's a get rich quick. The biggest mistake is thinking that they can be billionaires tomorrow. People don't want to wait, and even when somebody who's rational comes and tells them that's not really doable, you guys, you cannot make 50% per year, they will leave me. And like on my YouTube channel,
go find somebody who agrees with them.
Yeah. So there's this real story with one of my students now. The story is on YouTube because I made an interview with him. He came to me once. I told him about the 24%. Didn't really like it, too low. He went, and he's a smart guy. Like, don't think that you cannot be in this position. He's a smart guy, lost $500,000, and then came back to be a student. And the reason is this: there's a lot of scams out there that will promise you, that will play on the greed part. And it was a WhatsApp scam called something dumping. Anyway, it's a known scam whereby they push you or they convince you to buy a stock that is not really that good, and as soon as a lot of people buy it, they dump it, and it never goes up again.
Well, I know what you're talking about. This was in the news a little bit ago. My son does a show like this, and he was mentioning this. What they do is they buy they get a bad stock, convince you to buy it, and then
they get a lot of people to buy it. The stock goes up, they dump it. It goes down, and then everybody lost money. So, and by the way, I have 3 of my friends, the people I know that were part of something like that. And one of them is a university professor. So the common thing between them is that they're all smart, by the way. The common thing between them is that they don't understand that ROI and risk are the 2 faces of the same coin. You cannot get something or think that you can get all this money very quickly. I'm sorry, with all respect, if that's your position, you're stupid. You're going to lose your money. You're going to lose your money, okay? There's no free thing here. If something seems that it's so good to be true, you're taking so much. That's the cost. You're taking so much risk. And even if you didn't get to pay the first and second, third time, there will be time for you to pay. I apologize for my rudeness. I'm getting a little bit emotional. I'm tired of people losing money for no reason. Okay? So don't be stupid. Okay? So I'm going to say it again.
Yeah. All right, fair enough. Fair enough. Hey, it's great advice. Bottom line, this is similar to the one before, or is it? Am I missing something here? I think Randall's asking the same question as Anita. Yeah, as
So,
Anita asked earlier, what's the biggest mistake you see new options investors make? Obviously, that's the same question. I think there's
yeah,
another one similar, right?
yeah. And another way is treating like they don't understand that they are buying businesses. So if you buy a business, make your own
Good
video.
point.
You need to learn how to buy businesses, right? So
Yeah.
not lottery tickets. If you approach as a lottery ticket, you're gonna get the result of a lottery ticket. And by the way, the house always wins. Okay, so
Right. Right. So in what Chris Hanna's asking here, I like this one. This one's really, I think this is a great question because it's asking exactly the opposite of what the
yeah,
other two were.
good
What's your
question.
mindset?
So the
What's
mindset
your,
is that, and I went through this because I'm like anybody else. I'm
yeah.
greedy. I want free money, and one of the main mind shifts that I got is that I gotta stop chasing the day trader scalper because I took
Oh, yeah,
courses
yeah.
for that. But for me, the key is in the word consistency. The key is in the word, can I do this every day? Can I do this every month? Can I bet? Not bet. Do I
Can you
have?
do what every
Can I
day?
get consistent results? Like I don't want a result that is one high one day and then like because that is the normal behavior of a day trader. Really good one
Right.
day, losing 3 4 days. Like just very erratic. You need to spend a lot of time. I wanted something that is easy, only done with 10 15 minutes a day. I trust it. The worst case scenario is that I'm going to buy good stocks that I can wait on. I wanted something that is not erratic. So the biggest mindset for me was to give up this illusion that I can make 100% a year or 50 a year and go. I'm going to say go slow, but it's not slow. 24% is not slow for me, but go in
Oh,
a responsible way, in a calm way. Like forget about the hype. Like forget about, just calm down. Goose frappa.
so basically, your course in 12 weeks brings this bulk, this
Yeah,
basis. I mean, you still have to do the work. You still have to do,
yeah.
but
And
all the
and
mistakes you made that these people are asking, you can get that through
yeah,
the
that's why
course.
12 weeks. And it's not you're sitting down in front of me. I'm giving a lecture. You can't hide in this course. It's not a course. It's a mentorship. So the first hour is theory, but the second hour is I will look at the trades you did in the last week. Remember, it's in paper trading, so you can screw up all you want. You make all the mistakes you want. There's no cost. And I look at the trades and I give feedback. Okay, so I will give you shit if I see you ensuring bad stocks. Here's the thing, though, people accept me the way I am. I'm very rude sometimes, but they know it's coming out of love. They know that my objective and theirs is to get them to a point, right? So they not that they like me all the time, but they appreciate like when I get wind up on them and say, what is it that you're doing here? What were you thinking? They know I'm not. I'm not.
Coach has got to go after his people sometime. You got to get after them a little bit,
Yeah,
right?
yeah, and I'm very involved. Somebody did not show up for a coaching session. I called them and stuff. Anyway, so um, okay, I forgot what I want to say, but I have another question. What indicators do you rely on most before?
I like this question.
Okay, so there's 10,000 indicators. I only use 4.
Yeah.
I use
Oh.
MACD. I only use 4. So again, remember, I'm not a real trader, right? It's investing. So
True. Right.
I use them as I'll tell the 4, but I use them as advisory board. So I will look at what they say. If there's congruency between these 4, then I'll listen. If not, sometimes a lot of times they don't give me much. So MACD, RSI, which is forgot RSI. How did I forget that?
RSI
So
or ROI? I'm sorry.
RSI.
RSI. Okay.
MACD, RSI, stochastic, and Bollinger Bands. So these are the 4. The RSI and stochastic are oscillators. So they give you a number between 0 to 100. If it is more than 80, it's in the overbought category. It's kind of real estate. If a lot of people are buying houses, then the price of the houses goes up. So if it is in the overbought zone, it means that so many people are buying. Like, seems like there's some greed. Chances are, with some technical stuff I'm not going to go through, chances are it might go down later. So you know that it's so many people. And if it is in the oversold category, meaning a lot of people are afraid, they're selling, it's so cheap that it might go up again. The Bollinger Bands give, again, a little bit of statistics, but I'm not going to go in depth. It gives 2 sigma, or two standard deviation of the volatility of the stock in the last few weeks. So the next point gives about 95% probability that the next point in the graph, in the chart, will be between these 2 lines. Anyway, we use them to figure out if it is giving a bullish signal or bearish signal. Bullish means it's a signal that will say that the stock will go up. Bearish means it might go down. So overall, we tried not to predict the market. Timing the market is a game of the day traders, and they're usually wrong. It's very hard to time the market. So I don't care. So I want to use a strategy whereby I don't care if the stock goes up, down, or sideways, right? Like for me, I'm okay with a 3, and that's how you win. If you're okay with the 3, scenarios, then really you can't lose because you're okay with the 3, right? Yeah, and with a little bit of patience. Go ahead.
So, Antoni, I appreciate your question. That was a great question. And with that, Papa Lynn's, cool name. And you kind of pointed to this. I don't know if he's talking about numbers, and of course that depends on how much you've got in there.
The return, the average that I'm making much more than that, but for my students and the people around me, that the community around me that are doing this, 2% a month average is quite realistic. 2%, not in every month. It's not dividend, right? So it's not that every month you're going to do 2%. Right. It's the average. So some month you're going to do much more. Some month, if it's COVID, you're not going to do that much, right? And the way I think with this from a philosophical point of view, remember, 4 units of time the market is going up or sideways, 1 unit of time is going down, right? So if you figured out a way to make money when it's going up, and when it's going down, you didn't make any money. But all what you did is that you stopped yourself from losing money. Let's say that again. If for 4 units of time where it's going up or sideways, you're making money with this strategy or any. But when the market is going down, you found a way not to lose any money. Overall, you're going to make so much money. Of course, with my strategy, you can still make money when it's going down because we do something called covered calls. But if you just think this way, because what usually happens, remember, the normal person will buy at the top, sell at the bottom. What does it mean, sell at the bottom? He or she is booking a loss, right?
Right.
If that person did nothing when the market goes down, meaning it stopped. I'm going to share one more time because for me this is important. Example, the Meta one that went to 400. Are you okay with that if I share one last time?
Sure, absolutely, of course.
Okay,
it's a good chart.
So this is a chart with Meta. Okay, so Meta here, at some point of time, it was 389. Okay, and it went all the way down to 83. Okay, that was a disaster for a lot of people. Okay, because the normal people what will they do? They will buy here and they will sell here, of course losing a lot of money. But if you know that Meta is a good stock, if you know that it's pumping money, and the fact that the price drop is not really reflective of the value, it's allowed. In real estate, people like this. They like to buy a house at $200,000. They find motivated sellers or people who are in foreclosure or something, and they buy a house that is very discounted, right? That's the dream of any real estate investor. The stock market gives you the opportunity all the time, but you need to understand something called the intrinsic value. So if you knew that at that time, the intrinsic value, let's say, was at $300, if you knew that the intrinsic value is this red line here, $300, and right now it's at 80, the normal rational behavior is not to sell, is to go, like the people I know that know what they're doing, they were trying as much as possible to get money to buy it at 80, right? Of course, right now, if you look at this, it was like Meta went all the way up to 780. Right now, it's a little bit discounted at 633. The real value, based on the intrinsic value that I look at, it's about 850. That's the real value right now. It's about 850, so it's a little bit discounted right now. But what I'm saying is,
it's time to buy. Is what you're saying there.
Yeah. When the time comes, you need to buy. You need to have the right mentality and the stamina, because everybody else would be selling, and you will be the only one buying. But again, that's what
I like your mindset of investor versus trader, because it's a completely different mindset going in. How do you teach people discipline when they want fast results? Because you've brought this up a couple of times. That's probably why Cody here asked that question. You even said, don't do that.
For me, it's about the minds. So I talk to them and appeal to their rational part, is that it is smart to forego higher ROI for the luxury of protecting your capital. So I appeal to their rational behavior to forget about high ROI and fast results. Okay, so there's nothing called fast results. So and I give stories. So for example, the story, did I talk about the story about me in Toronto driving to Florida? Did I share that? I did. I don't think.
No, okay. You have not. No.
I live near Toronto, and for me to drive to Florida, it takes 24 hours driving. Okay.
Nice. Yeah.
If my objective is that I want to reach there fast, I want to reach there in 3 hours driving, I know how to drive. But if my objective is wrong, which is the fast, I want to be there fast, I will have to, my objective will push me to drive at 800 kilometers or miles per hour. That's the only way I can reach there in 3 hours. Okay? So if my objective is to be there fast and I drive at 800 miles per hour, it is just a matter of time, you guys, whereby I will be in an accident. Even if the first hour I drove, because I get some people telling me, I'm doing what I'm doing. I did not lose money for the last year. This does not mean that next month you will not lose all your capital, right? So go slow. To reach faster, you need to go slow. So driving at 800 kilometers per hour, I think I'm going to be there. I probably will never reach there, right? Either I'm going to be in jail or I'm going to be in an accident. So for me, what I'm doing is the fastest route, right? I need to slow down myself and be responsible so that I can reach there. Reaching there is more important than reaching fast. I guess we should all agree.
I love that. Cody, great question. And Clayton's got another question here. Okay. A couple of people have actually asked multiple questions.
Clayton,
what advice would you give somebody?
You're smart. You should be afraid to start options. Options, you guys, are very risky if you don't know what you're doing. Very, okay?
True.
That's why I don't do the 50 strategies. I only focus on 2. So what you need to do is a couple of things. Number 1, you got to learn it first. Okay? So 3 levels of learning, the free stuff, YouTube. Okay? Second is you buy a course. Third is mentorship. So 3 levels of learning, go one at a time. So that's number 1. Number 2, never put money right away. You need to try whatever strategy, whatever guru you're following in a paper trading account. Paper trading account, did I talk about that? You have to start in a paper trading account. It's free to open. You don't need to put any money. And you try your thing and you check that you can make money consistently in it before you commit any money. Okay? So that is the route, is to not put money. Learn and try it.
And get experience. Learn, try it, which equals experience.
Yes, yeah.
I'm going to get to your. I'm going to get to your contact information here in a second. I've got a couple of them here, but I want you to read these next two items. Read that, please.
Danielle, thank you. Really enjoyed the episode. Great energy. Love it. I hope this was of value, because for me, it's very important to get the thing out there. It is very hard on everybody. And if you keep on just playing the 9 to 5 game, it's not easy to get out. So you need to find a way whereby you invest in an investment has risks, of course. There's nothing. Anybody who tells you these words is a scammer. No risk. That's a scam. There's nothing called no risk. Anybody who tells you anything is guaranteed, that's a scam. There's nothing, right? Anything that tells you huge ROI, no effort at all, that's a scam. Okay? So there's so many scammers out there. So just be careful. Fadi explains complex ideas so clearly. Thank you. Thank you, Rick. I hope you enjoyed it.
So that actually came up perfectly from when you said that, because you were asking, I hope people understand what I'm saying, and da-da-da-da-da. Well, okay. Rick right here just kind of confirmed that you're nailing this. There's still we're an hour and a half into the show. There's still 520 people on here.
Okay, I can come
you
again.
You made an impact, Fadi. You made an impact.
I can come again if you want me.
Yeah. No, we do repeat shows at times. Okay, not repeat, but have guests come back on. Why don't you give? I know you're right up against the wall here, so I told you I'd manage it. I thought I'd manage it. Yeah.
Very well.
So let me before I ask you to do one last thing, make sure I got this done right. It went wacko on me for some reason, kind of split it up. But that's your email. That's your LinkedIn.
Yes.
Which you have a really nice LinkedIn following, by the way. That's your Facebook, YouTube, which I've seen a couple of your shows. Really, really good. This is your. Why did that split it up there?
Yes. Yeah. So let me put the YouTube and Instagram again. So
Facebook looks good. Instagram's good there, right? Legacy Wealth Builder, the bottom one.
Yeah, and
I think
YouTube
the one that got messed up is YouTube.
Okay, so I'm gonna give it to you again, because I think that's the most fun one, the YouTube.
Wow. Okay, so you've got YouTube on here twice.
Yeah, I gave you the last one. Sorry, just the last one.
Oh, okay, just the last one. I know what you're saying. Copy, and then there I'm going to put it right here, and this is the one you want people using the most, right? Because that's paste. Let me just make sure I got this right, because I don't always see as well as I'd like to with these little letters here.
I know.
Right here, and then there's your YouTube, and then why don't you give you like I said, you got 500. You held 530 people for an hour and a half. Why don't you give something you want to leave with? And that YouTube's correct, right, Fadi?
Yes, correct. Yeah, thank you.
Okay. What do you want to leave as a final comment and before you give a big wave to all your fans here? This has been a really good show, especially during the holiday season. I'm kind of cautious about how many people are going to be coming on.
And the host is very smart in asking questions, so that's why it's I'm usually not the very interesting like in this episode. Anyway, what I want to leave with people is that
wait. So what you want to leave with people is that I'm an awesome host. Is that what you're saying?
Yes, you are. That's true. Like I don't think I'm BSing when I'm saying that. You are an awesome host. That's correct. I love the energy.
Okay, say that one more time. All that one more time. I'm going to clip this and use it.
Rodd is an awesome host. I'm going to say it everywhere now. Okay.
Yes, you will see it everywhere. Trust me.
Okay.
All right. So final thoughts, wave, all that. Final thoughts. What do you want to leave people with before you go about your day and start making another 20%?
Okay. What I want to leave people with is that I can see the people who were only betting on the 9 to 5. I got restructured like 3-4 times in my career. Okay. You do not want to be restructured at the age of 50, and that's the only game you're playing. Okay. So what I want to say is that you have to be an investor. Okay. I made up my mind very early that I need to be in that space because 9 to 5 is just not enough, especially that I was in manufacturing and everything was going to China. And like some companies I had, they were firing people every month, every 2 months. Anyway, so decide if you want to be an investor or not. Being an investor doesn't mean you quit your job tomorrow. Took 20, 30 years for me to get to the point. Hopefully you will be much more smarter than me because I made a lot of mistakes. So that's number one. You got to be an investor.
That.
2, you got to start with one of the two, stocks or real estate, not both, because it's a craft you need to learn. Okay. It's not luck. Okay. There are systems that you need to learn. So choose one, figure it out. For me, I did real estate and nothing but real estate for 10, 15 years. So choose one, learn. You learn, there are 3 levels of learning. Free, you should start there. And then you invest in a course or invest in mentorship. The mentorship, choose the mentor wisely. Okay?
Wisely.
There's so many people will promise a lot because they are so salesy. I am not. I'm an engineer. I'm trying to learn how to be a good salesperson, but I'm failing so far. But anyway, so just you gotta understand. You gotta size people up, whether they're salesy, they're promising a lot, and there's some so expensive programs out there that doesn't deliver. And you finish a course, and they will tell you, to be able to do what I just told you, you need to buy this other course, right? So figure it out, look at testimonials, understand, talk to people who are graduates of this program. So learn and start implementing it in a way whereby you don't die if you got it wrong, because you will get it wrong sometimes, right? So that means in a paper trading account, in stocks, in real estate, try to go with another person so that try to amortize the risk a little bit, reduce it. More people, get other people who are real estate investors to look at your deal before you go and do it, right? And
good point.
Huge money to be made. Stay the course, and I'm very optimistic that whoever is committed to learning whatever I said here can do it at some point of time, because it doesn't need, like Warren Buffett said that all the time, it doesn't need a lot of IQ. By the way, another statistic for you, the correlation between intelligence and wealth, they actually did the math, the study, is like 4%. Okay, so good news for all of us here. We don't need to be smart to make money.
I'm taking. That's the best thing. Well, not the best, but that's a good thing I'm taking away.
Really, I actually just took a course in psychology of wealth, and they actually figured it out, how much your intelligence, and that's why two people, like I always think of myself as intelligent, but I look at the person beside me. In my head, they have half the intelligence than me, but they're much more successful when I was a real estate investor. I didn't understand why, because performance, you guys, is in the domain of action. A person who is not that smart compared to you, if he or she is taking action, one or two things will happen. Either they will make a good decision and will repeat it, or they will make a bad decision and learn from it and move on. Both ways, they are miles ahead of you. Anyway, I talk a lot. I need to shut up. So
Hey, I appreciate that. Oh, and by the way, you said you're not as much of a salesman-y kind of person.
No.
So I'm gonna do a sales pitch and say, hey, well, give us a little sponsor thing, and we'll mention you every day, and that'll definitely affect your sales.
Okay, cool. We'll talk.
All right. You got it, brother. So are you going to wait in the green room for me while I close down, or no?
Yes. Yeah, I can. Yeah.
Okay. I'm going to throw you in the green room. Give everybody a big wave. And
hi, everybody. I enjoyed being with you guys. Questions, really smart questions. Thank you.
They were really smart questions, and I think you've got some activity coming up. Hey, another great show is advertised, and I just kind of want to go back and chat with my buddy Fadi back there in a little bit, but I did want to leave you guys with some closing thoughts here. As we wrap it up today, I want to leave you with this thought. Most people don't avoid investing because they don't care, right? They avoid it because they care too much to get it wrong. Make sense? They're protecting their families, right? Their futures and their peace of mind. That's where this all comes from. And that's not fear. That's responsibility. What conversations like today's are meant to do isn't push you into action. It's to replace confusion with clarity, guessing with understanding, and anxiety with confidence. Because when you understand why something works, and that's what I loved about the way Fadi went through everything today, is some of the audience really pointed out. When you understand why something works, you stop feeling like you're gambling. And that's kind of what the basis of this show is about, this particular episode. And when you start feeling like you're deciding, that's what we aim to do here on Insights and Straight Talk with Rodd Duff, your host, and producer Barbie, week after week. Well, literally day after day. If today's conversation helped you think differently or even just breathe a little easier about money, here's how to stay connected. Insights Straight Talk.substack. That's where we go deeper. That's where producer Barbie and I share behind the mic revelations. We extended insights from our guests, practical frameworks, and conversations we didn't always have time for live. It's also how you support the show and help us bring grounded, responsible voices to the great middle class. No hype, no noise. That's our mantra. Just straight talk. If you're watching live, drop your questions and thoughts below. If you're watching on the replay, let us know where you've been tuning in from. And as always, thank you for being part of this community that believes financial confidence should be built on understanding, not fear. We'll see you next time. This is Insights and Straight Talk. I'm your host, Rodd Duff, and after the outro, stay on. I'll say something funky. I don't know what it is yet, but I am out.
Before you leave, if you'd like to watch another one of the podcasts, click the first link in the description. We love having you here and we appreciate all your support.
And with that, producer Barbie and I are out.